The open day looks like the answer, gardens, buses, afternoon tea, until you run the exit maths and find $150,000 can quietly leave with mum after a decade on a $500,000 entry. By the end, you'll have an 8-point family checklist to run before any holding deposit feels too late, what the 2026 reforms changed and what they left alone. We checked this against Consumer Affairs Victoria's reform guidance and leaving fees pages, plus the ABC reporting that pushed the crackdown, not the sales brochure from the open day. General information only, not personal advice. Check a licensed professional for your family's contract and timing. In a lot of migrant and first-gen households, the mum should move talk starts with the garden and the stairs and ends with a 40-page contract nobody wants to read aloud. We assumed the big 2026 rewrite would make village contracts safer by default, clearer paperwork, fewer traps, less inheritance shock. Here's the cleaner way to see it. Victoria clarified how new contracts disclose fees and calculate exits. It did not magically erase deferred management fees. Clearer maths is a win. Cheaper exits are a different question, and that gap is why families still need a checklist, not just a news headline. Key date 1 May 2026 when new contract rights and obligations kicked in. Key date 2 1 September 2026 when the prescribed standard form contract becomes mandatory. Consumer Affairs Victoria calls this the biggest change to the Retirement Villages Act since 1986. That sounds dramatic, and for operators it is, but families still have to read their own pages. The legislative vehicle is the Retirement Villages Amendment Act 2025, backed by the 2026 regulations. You do not need to memorize the act. You do need to know your contract date against 1 May. Through August, operators could keep older form layouts if those forms already met the May rules, so we used our old template is not automatically illegal, and it is not automatically safe for your family either. If mum signed before 1 May 2026, many exit and fee clauses stay as written. The reforms are not a free rewrite of every existing residence agreement. Some village-wide duties still help older residents, clearer dispute pathways and annual contract checks that estimate what leaving would actually return. Do not assume the news headline upgraded mum's paperwork. Ask a solicitor which clauses are locked, then sleep better knowing the answer is specific rather than hopeful. If this already feels heavy, that is normal. These contracts are designed to be long. You do not need to solve the whole decade tonight. You only need the next honest document. Give yourself permission to pause the sales rhythm. A week of reading beats a year of arguing about a clause nobody highlighted on open day. The garden will still be there after the solicitor meeting. Path 1 feels like relief, one-level living, neighbors close by, less stair panic, and a community bus instead of another lonely drive. The trade-off is capital structure. A large entry payment goes in up front, and a deferred management fee usually comes out when she leaves. The hurdle is treating the open day as the decision. Marketing sells lifestyle. The information statement and the exit formula sell the truth. Path 2 keeps mum and the family home a bit longer, rails, cleaning help, meal support, adult children rotating weekends. The cost is time and coordination. It can be cheaper in cash than a village entry payment, and harder on siblings who already work full weeks. The hurdle is honesty about falls, isolation, and how fast care needs can jump. Staying home is not automatically safer just because it feels familiar. Path 3 is the care conversation. Families postpone, higher support needs, different funding rules, and a timeline that may not match a leisure village pitch. The catch is cash timing. If mum may need higher care soon, a steep early exit fee can erase the community living benefit before it amortizes. Many families will touch more than one path across a decade. The point is not picking a forever label today. It is refusing to pretend the first open day answers the later chapters. So pause on this. For your household, which matters more right now, community living soon, more time in the family home, or keeping cash flexible for a care move you cannot schedule? That trade-off lands differently for a renter supporting parents, a mortgage household bridging deposits, or a regional family driving hours for weekend care. A deferred management fee, also called a departure fee or exit fee, is usually the largest deduction from the refund when a resident leaves. For contracts signed on or after 1 May 2026, that fee must be calculated as a percentage of the original entry payment, not the resale price, and it accrues day by day. It stops accruing when vacant possession is handed back. That detail matters if the move-out stretches across weeks of sorting and cleaning. Using Consumer Affairs Victoria's own example rates, 3% a year up to a 30% cap, a $500,000 entry can face about $15,000 after 1 year and $150,000 after 10 years once the cap is hit. That 30% figure is an illustration in the guidance, not a hard statewide ceiling. Your village can still write different rates and caps into the contract. On that illustrative decade path, the refund before other deductions lands near $350,000, and reinstatement or capital loss sharing can shrink it further. At 5 years on the same illustrative rates, the deferred fee is about $75,000. That midpoint matters for families who think we'll only try it for a few years. Deferred fees are usually the largest slice, not the only slice. Unpaid charges and reinstatement fights can stack underneath and surprise estates at the worst possible time. That number is not there to scare you off community living. It is there so the inheritance conversation happens before the open day glow makes the decision for you. On post-May contracts, operators generally have up to 12 months after permanent vacation to pay the exit entitlement, sooner if the contract says so. 12 months is still a long bridge if care costs arrive earlier. Model that gap against savings and family support before you assume the refund lands on schedule. For new contracts, once vacant possession is handed back, maintenance charges should stop. Older contracts can still allow charges to run for months in some cases. New contracts must not put a higher share of capital loss on the resident than capital gain. Uneven loss sharing is one of the quiet inheritance drains families used to miss. For many new agreements, renovation is no longer an automatic exit tax. It needs a written deal covering scope, cost sharing, and capital treatment. This is why the crackdown happened. ABC reporting described exit structures that could strip huge sums on departure, in one case a deferred fee reaching 60% of what the villa reaped on resale. The new rules push new contracts towards simpler entry-based daily maths. That is transparency. It is still not a promise that the percentage will be small. New contracts must include a 7-day cooling off. A prospective resident can cancel and pay only a government-set administration fee if the right is actually used in time. Operators must provide the information statement on request and at least 21 days before entering a management contract. Treat that document as the fee map, not optional reading. Non-owner residents also get a prescribed condition report before move-in. Photograph everything on day one. Future reinstatement arguments love missing photos. Here is the sober layer. A village can be a genuine quality of life upgrade and still be an expensive capital product. Both things can be true in the same week. If mom might only stay 2 or 3 years before care needs escalate, a steep early deferred fee can erase the community benefit before it has time to feel worth it. Picture a household selling the family home, putting about $500,000 into a village entry and assuming the kids will get most of it back later. That assumption needs a spreadsheet, not a hope. Honestly, the part that surprised us was how often families argue about the garden and never once ask for the 5-year and 10-year exit estimates in writing. Once mom is in, operators must provide an annual contract check estimating what leaving would cost and return. Ask for one before any quiet plan to move again. Operators may only charge for a contract check when the resident requested it and has not already given notice of leaving. That detail stops a nasty bill right when cash is tight. Keep 4 documents on one page for the family chat: information statement, residence contract, condition report, and bylaws. If a fee was only spoken, it is not finished business. Bylaws still shape daily life: pets, visitors, parking, noise. The fee fight is louder, but these rules decide whether mom feels at home in week 2. This caught us out too. One sibling falls in love with the lifestyle, another only sees the exit line. Name that split early, or the open day becomes a family argument with better catering. Exit fees are not only an operator issue. They change what remains for aged care for the surviving spouse and for whatever the will assume the house sale would leave behind. Once you can see the trade-off, you are no longer guessing, you are choosing. The next step is a boring checklist, and boring is exactly what protects the household here. So here is the practical resolution: 8 checks you can run this week before anyone feels locked in by politeness or open day momentum. 1. Confirm whether the contract is pre or post 1 May 2026. 2. Collect the information statement and compare every verbal fee to the written list. 3. Highlight the deferred fee clause, rate, daily accrual, and cap. 4. Run exit scenarios at 2, 5, and 10 years using the contract's own estimates where provided. 5. Map the cash bridge if exit money can take months. 6. Photograph the unit against the condition report on move-in day. 7. Book independent legal advice before any deposit feels irreversible. 8. Ask where the dispute policy lives, and no Vic Assist exists as a free conciliation pathway in Victoria. Do not plan to just use the 7-day cooling off later. Cooling off is a safety net after a careful read, not a substitute for reading. Sales momentum loves a small holding deposit. Politeness is not a legal strategy. If the paperwork is incomplete, waiting is allowed. When relatives of ours sat an open day, the glossy tour came first and the fee schedule came last. Next time we would reverse that: order worked examples first, gardens second. Write this blueprint tonight. Gather the information statement and draft contract, force 3 exit scenarios onto one page, then take both to a solicitor before anyone signs. If you only ask one question at the open day, make it this: show us the written exit estimate after 2 years, 5 years, and 10 years on this unit under this contract. And for the solicitor, which clauses are locked because mum already signed before 1 May, and which village-wide duties still help her anyway. You do not need to become a retirement village lawyer. You only need to stop treating lifestyle marketing as a substitute for exit maths. A slower, document-first decision is not missing out. It is protecting future freedom for mum and for whoever has to untangle the paperwork later, and that is a strong, calm move. If this helped map the family conversation, subscribe. We put out one of these practical guides every week, built for ordinary Australian households.